Hello everyone, this is Mark with Semantics Trading with your daily report. So today we had a nice gap up on the markets overall, and as the CPI number resulted in a softer than expected inflation data, we did see the CBOE VIX fall under 20 for the first time since April, and the dollar has dropped the most since the pandemic. We did come below consensus expectations on both the headline and core CPI. While the headline CPI is 0 month over month, we are still seeing the core increasing 0.3% month over month, which does raise concerns as the inflation rate will likely be elevated longer term as core can be more stickier and stubborn. We did see the largest drop in monthly headline inflation since the 1980s, which is largely due to the rapidly declining energy prices. Meanwhile, core CPI remains high, but has halted its momentum. To be celebrating this positive report is a bit early, as core services are the most stickiest component of the inflation basket, and there is much work to be done to fight this stubborn core CPI. We have seen sectors such as energy, commodities, used cars, and trucks drop in price, but services and rent are still the biggest are now the biggest drivers of inflationary pressures. It's quite possible to see disinflation assist us with the battle with inflation, as inventory being overstocked and consumer demand destruction can lead to weakness in good prices as inventory is dumped. However, energy remains high and volatile, as if we take a look at the Strategic Petroleum Reserve, it is draining at a rapid rate and reaching historical lows, as well as gasoline demand reaching spiking after a bit of a muted demand from the last report by the EIA. And we do also see rent inflation still climbing higher and being a bit stubborn. So for the equity markets to price in, if the data were to soften, and we can continue to see a softening of this data as we get closer to the rate hikes that are projected to be next year, this will likely be reflected in a steepening of the yield curves and result in tighter credit spreads and the US dollar further weakening, which does help the equities markets quite a bit. But do note that we are quite far away from the proposed Fed neutral rate, and although the market is pricing in rate cuts for the next year, that should not be relied upon, as that is not the practical information, but rather just a directional of which the market thinks we will head towards. There are projections that the rental market is set to cool sometime in the fall, which is good for inflationary fears, as it is a very sticky component of inflation numbers. And if that could come down significantly, that will help deal with the core CPI. Now, if you take a look at the volatility for NASDAQ, VXN, we do see the volatility for tech move lower, which leaves us with a good opportunity to hedge as volatility pukes. And we've also seen a shift from short gamma to positive gamma after the inflation print this morning, and this basically means that the short gamma dealers are forced to buy deltas, which results in a squeeze as we've seen today. And with that being said, that is it for today's report. I want to thank you all for watching, and I will see you next time.